and welcome to this very special interview. Joining me today is Mahendra Jajoo, who's the Chief Investment Officer Fixed Income at Mirae Asset, one of India's fastest growing mutual fund houses. Thanks very much, Mahendra, for joining me in these difficult times. Mahendra, talking about the risk involved in investing in debt, recently we saw a lot of concern around credit risk funds. So when you invest in a debt fund, is the risk more in terms of the credit risk, or is it more about the interest rate risk? Because interest rates again move in accordance with what the RBI does, both again not in control of the investor. So how do you, what would you explain to an investor how to navigate risk when you're investing in a debt fund?
Sure. So there are two primary sources of return when you are talking about debt funds. One is the duration risk and the other is the credit risk. So you look at funds like gilt fund or dynamic bond fund, which primarily derive the return from interest rate volatility. And then there are credit risk funds or other corporate bond funds. Some of them who invest in more aggressive credit quality companies and hoping to make an extra return over and above the risk-free return. Now, one of the core philosophy that we always follow is that the market risk is temporary and the credit risk is permanent, which means that if someone is stuck in an interest rate volatility, as long as he has the patience to remain invested through the interest rate cycle, he is likely to come out with reasonable returns. But in case of a credit, if something goes wrong, if an accident happens, then the recovery is generally very, very poor. So the first and foremost prescription that I normally have for debt mutual fund investors is to avoid aggressive credit risk, because if an accident happens, the recovery is unlikely to be very, very good. As far as the duration risk is concerned, interest rates do go through cycles, and interest rate is one product today in the world which is the most controlled by the central banks. So the central banks, the economists, the government, everyone is watching the interest rate movement, and there is a self-balancing mechanism in case of interest rate cycles that if inflation goes up, central bank will increase the interest rates, which will in turn moderate inflation, which will then again call for the interest rates to come down. So I think one can, rather than getting intimidated by the interest rate volatility, benefit by the interest rate volatility by investing in a systematic manner, much as we do SIP in the equity funds. One can do SIP in the debt funds, especially the dynamic funds or the bond funds or the gilt funds, and then you can expect a good return. So I think the markets are always going to be volatile. There is no free lunch. So if someone is wanting the safety of the bank FD in terms of the stability or linearity of the return and no volatility, then he has to be prepared for foregoing the extra returns that embracing that volatility will bring. So investors should focus on his investment horizon and ensure that his risk appetite allows him to absorb that volatility, avoid the credit risk, and focus on the interest rate risk. Now, if someone wants to take credit risk, he can rather invest in a hedge fund which is going for stressed debts rather than trying to pick up that extra return in the credit risk funds. That is our view.
It's been a pleasure talking to you, Mahendra Jajoo. Thank you very much and wish you all the very best. Hope you continue to serve Indian investors equally well in the future as well. Thank you very much.
Thank you, Vivek. Thank you so much for inviting, and thank you so much once again.
Absolutely. Thank you very much, Mahendra.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.